And kia ora, and welcome to a special edition of the Hoon on the Kaka, where we look at a couple of big events today. The Reserve Bank has cut the official cash rate as expected by 50 basis points to 3.75% and has brought forward its expectations of more rate cuts from later this year, early next year, towards mid to early of this year. And so that's the news today. And at the same time, we've also had the latest Real Estate Institute of New Zealand monthly sales and price figures through for January. Those are both big events in the housing market and our economy. So we're very lucky to have with us Nick Goodall, who's the head of research at CoreLogic. Nick, lovely to see you. To talk about the housing market and interest rates and all those interesting things. And we're very lucky too to have Jen Baird, who is the CEO of the REINZ, who's here to talk to us about the numbers that have come through today. Jen, lovely to see you.
Thanks for having me.
Firstly, Nick, we've seen the official cash rate cut and the Reserve Bank's come up with a bunch of new forecasts. What did you make of today's decision and forecasts and chatter from the bank?
Yeah, I mean, essentially, as you said, the cut of 50 basis points was well expected by the market, by all economists. So no surprise in the cut itself. The big surprise for me and for other analysts was the speed at which they see the next cuts happening. I think previously we were expecting maybe another 25 basis point cut in 6 weeks' time, and then a bit of a wait and see attitude. They seem to have brought forward that expectation to the point where maybe even the next one, 50 basis points again. If not, maybe 25 and 25. So it's really about bringing forward those cuts. The economy needs support, and they'll give it through those monetary policy cuts, and then sooner rather than later.
Jen, today we got some numbers from the Real Estate Institute about house sales and prices for January. Just broadly, how is the market feeling and acting?
Well, what we're hearing from agents all across the country is that sentiment in general is improving. So the 50 basis points that we had last year, the spectre of today's announcement, the Reserve Bank making good on 50 basis points today, all adds positive sentiment into the market. What we've heard since towards the end of last year is that people are seeing more activity at open homes, more people in auction rooms, buyers kind of realizing that actually the affordability equation is starting to move in their favor. So they are starting to make decisions. That said, one thing we continue to see is people bringing properties to market quite a lot, 20% more than this time last year. So lots of properties for sale, and vendors' expectations when the interest rates start coming down is that prices are going to shoot up, but we are not seeing that. We haven't seen that over the last 12 months. And with nearly 33,000 properties on the market for sale today, we're unlikely to see that. So people still need to be really realistic when they're bringing properties to market at the moment.
How do you think today's announcements about the official cash rate and this news that we might see 3 rate cuts this year and probably a bit earlier than some people might have expected, how might that affect the market?
Look, I think there'll be relief, and then I think we will continue to see that positive sentiment flowing through. I think it will give buyers more confidence that making a decision today or stepping into the market with a view to buy in the coming months is going to give them what they need, that from an affordability perspective, they're in a better position to get what they want. So we would expect to see that through the summer, which is always a busy time in real estate. But I think we're all hoping for a stronger showing in the market for much of the year.
Nick, I'm curious about what you're seeing in terms of sales volumes and values and whether or not today's decision might change things at all, particularly the volumes, the actual sales going through, because we seem to be in this strange sort of standoff period where, everyone wants to sell and there seems to be a few people who are interested in buying, but they're not interested in paying more than CV or, 2021 prices. And so everyone sort of stands back. There's a lot of people who eventually take their houses off the market. What's your feeling about this sort of, for the want of a much better word, Mexican standoff?
Yeah, look, I think we have seen an increase in transaction activity throughout the last few months. When we look at the last 3 months compared to the same 3 months before, particularly for the main centres, we're generally 10 or 15% above where we were the same time last year. So the wheels have started to get greased a little bit in the market. I think, when you look at the decision today to cut the OCR and to probably bring further cuts forward, that will bring that confidence to market. We've seen a real reduction in those owner-occupiers moving house. in the last couple of years. And those are people that, have had life stage changes, whether it's I want to move to a school zone, whether it's I've had a kid and want to have a larger house. All those things haven't stopped happening, yet we haven't seen those movers out there as often as they were previously. And I think as this happens and their current mortgage will roll onto a lower rate, and we see that from the Reserve Bank data, where the average rate across all stock of mortgages is now higher than the 1, 2, and 5 year rate. So what that means is that most people rolling onto new fixed rates this year will likely be on a lower rate than they were previously. And that just gives them that confidence that they can go and upgrade that house or move to that new region. And I think as you see that sort of chain of events, those chain of transactions start to loosen up, you see all the rest of the market start to improve off the back of that as well. So I do think this is going to bring that activity further forward, and we will start to see the market move a bit quicker. And that will likely have some upward pressure on prices. But as Jen said, I think this, what we call an inflection point to the market, which we were expecting to come maybe a little bit sooner, it's just being dragged out a little longer as those stock of listings just holds high for a little bit longer than we expected. So it has slowed down that turnaround point.
Jen, this interesting issue where they've got a CV that came to them a couple of years ago. It's a big juicy one, and they want to move on with their lives, and they put their house on the market, and there's some great pictures taken, and the open home signs go up, and then there aren't that many offers anywhere near the CV. How much of a psychological sort of block are these CVs that are out there, and could a new round of CVs at lower values, 10 to 20% lower, depending on where you are, might that be the market clearing sort of change that gets people thinking differently?
Yeah, look, I think this is a really interesting one, because whenever anybody is thinking of buying or selling a property, they're casting about for some indication of what their property is worth and what they should be thinking about, putting on paper when they're buying. And people have historically used CV to do that. But I think it's the wrong thing to do. I just don't think that it stands that you can arbitrarily say, 10 or 15% more or less than CV is where properties around here are selling for. That just, that's not what CVs are for. I would say this, but the best way to understand what your property is worth on the market today is to talk to somebody who's in the market all day, every day in your local area. And that is a real estate agent. They know what's changing hands. They know what sentiment is happening. And really, at the end of the day, if you are in the market to sell your property, the best advice is to make it as attractive as you possibly can, and then look to hit the market and hit the market strong. That's going to be what gets you the best offers early in the process. I would absolutely recommend auctions for that as well. But then you have to watch the market come to you. And this is what's really challenging when it's your house. It's different when everybody else's house, right? Everybody else's house, you can be really rational about it. But your house is special and worth more. This is just a mindset that everybody has. But, really getting all the recent sale data and really talking to agents in your area and understanding that value is a really, really important part of heading towards the market today. That's a way better option than thinking about CV.
Nick, this issue of the market clearing, in other markets, let's say the United States during the GFC, you had people mailing their keys back to the banks. Now, different situation here, unlike in the United States where some states have, non-recourse loans and you could do that, mail the keys back. And the banks were, shooting first and asking questions later. Whereas in New Zealand, the banks don't do that. If you're up with your payments, they're not going to kick you out. They're going to hold. How sort of stressed, or how many mortgages are behind? What sort of mortgagee sales are we seeing that would suggest some people might choose to take a lower price this time around? Or are people finding it really, psychologically difficult to accept what they might think of as a loss? And we know from, behavioral economics that acceptance of losses is much more painful than celebrating gains, if you know what I mean. So tell us about that.
Yeah, I think for many people, the plan is always to hold on if you can. And it's one thing that has to be said about the banking and lending industry is that it is much more responsible in its lending. We've obviously had the loan to value ratio rules in place for over 10 years now, and that has meant many people getting into the market have got a sizable deposit. And so they also have reason to stick around. We've now got the debt to income limits, which will start to restrict people on how much they can borrow to get into the market in the future. And that will just further ensure that the market is more robust and there aren't so many people that will be struggling if and when the market turns. You've also got to look at our labour market, and we have a very strong and robust labour market. We've seen a rise in unemployment, and that's difficult for those people going through that. I don't want to underplay that, and those people that, with a reduction in income might be struggling to make their mortgage payments and would look to sell their property. But it is relatively small part of the market for many people. Have been able to get through this. And now with interest rates falling, as I mentioned before, mortgage payments hopefully reducing, I've sort of got to a point now where you can cling on for a little bit longer. If you then do want to sell, of course, how do you figure out that price is going to work for you? If you bought at the peak and want to sell now, you are almost certainly going to be taking a lower price than you paid, but hopefully it doesn't put you in negative equity, which puts you in really difficult financial strife. But that's why the plan would absolutely be to hold on. Now expectations also turn to see, we do expect capital growth to return to the market, albeit slower than maybe in the past. But once again, you should hopefully see your equity increase over time through both paying off your mortgage and seeing the value of that asset increase. And once again, your financial situation should improve. So I think, again, we've sort of got to this position now where we're in a much more positive position. We haven't seen the lift in mortgagee sales. I think I looked at the latest data. We had about 41 in Q4 last year. It was 60 odd in Q3. But you go back to the global financial crisis, it was more than 750 each quarter for multiple quarters in a row. And that just shows that robust nature of lending, labour market, people's situation, we're just not in that state.
It was interesting in 2009-10, when the market was recovering as interest rates were falling, we had house prices drop 10% during the global financial crisis. But they bounced back quite quickly, in part because in 2009-10, there were no LVRs. There were no DTIs. I'm curious, Nick, how you think the introduction of the DTIs from July last year, which had no impact then, but as interest rates fall and as some of the rental property investors in particular come back into the market, how much might that restrict some of the lending growth that some people might be relying on?
Yeah, look, absolutely. And I think with the DTIs restricting how much you can borrow compared to your income, they're set at 7 for investors, 6 for owner-occupiers. Right now, as you said, they're not really taking any effect because about 5% of lending is done above those limits, and the banks are allowed to do up to 20% of their lending outside those limits. Right now, though, high interest rates, or still high interest rates compared to property prices, mean that you can't afford to borrow more than 6 or 7 times your income anyway. But as interest rates continue to fall, that will start to change. Now, our very rough forecast, and I will say they're very rough, do suggest that once mortgage interest rates are in the high 4s and low 5s, that's when we might start to see these debt to income restrictions start to bind, and that their conversation for those potential borrowers with their brokers or bankers will actually start to kick in. But remember, there's a 20% allowance. I suspect the banks and Reserve Bank will see that allowance used in the more expensive areas like Auckland, Wellington, Queenstown to ensure those markets continue to transact. But the biggest impact will be to investors. They simply won't be able to increase their income at the rate they would increase their debt to get an enlarged portfolio. So it's going to slow down the rate they can buy, the amount of properties they can own over a long period of time. So we might see more smaller investors, owner-occupiers benefit from that, but those big investors are going to struggle long term.
Just finally, Jen, what do you think we'll see through the rest of the year in terms of who's going to be potential buyers? Is it the investors? Is it the first home buyers? And how much might the DTI play a role here?
Well, I would agree with Nick's assessment of the impact of DTIs for investors in particular. It's really only been the last month or so that agents have started saying the word investor to me again. It's really been about people moving house, and first home buyers have been a really big story over the last little while. Look, investors are there. They've always been there, particularly the ones with equity. It has been a really great opportunity to pick up property at affordable prices over the last 6 months or so. But we are starting to see investors looking again. And as interest rates continue to ease this year, we would expect to see them back in the market.
Jen Baird from REINZ and Nick Goodall from CoreLogic. Thank you very much for coming on a big day in the housing market and the economy. Thank you very much.
Thanks.
Cheers.
All right.